And a very good afternoon, investors. You're now on KleverStock with me, Wan Izul, and I'll be serving you the midday roundup with the latest market updates from this morning up until now. Hopefully, everyone had a lovely long weekend for the Thai Pusam break. Bursa Malaysia markets are open today, so no two-day public holiday for us. So, kicking it off with Bursa Malaysia updates for this morning. Blue chip stocks on Bursa Malaysia surged 0.8% this morning as the trading resumed after a long weekend, indicating that domestic markets' buying momentum remains firmly intact. Now, the benchmark FBM KLCI climbed 15.21 points to 1,756.09 at the opening bell as investors aggressively moved to reclaim the multi-year closing high established on January 27th. Now, Apex Research anticipates that the FBM KLCI will likely trade within a range-bound trajectory in the near term. Now, this outlook comes as global markets present mixed signals while investors continue to digest the US macroeconomic data and a busy slate of corporate earnings releases. Now, the research house noted that buying interest is likely to center on high yield and earnings visible names, particularly within the banking sector, while selective consumer plays may see interest on expectations of improving domestic demand. Now, however, they cautioned that potential upside could be restricted by a cautious foreign positioning and lingering global market volatility. Now, from a technical standpoint, the market's indicators have turned quite positive. The moving average convergence divergence, the MACD line, is currently trading above its signal line, while the relative strength index or RSI remains comfortably above the 50-point threshold. Technical analysts have also identified the next immediate resistance level at 1,750, with psychological support expected around 1,685 mark. Now, the banking sector spearheaded today's rally. Maybank, they jumped by 16 cents to 11 ringgit 94 cents. Public Bank and M-Bank gained 7 cents and 8 cents each to trade at 4 ringgit 94 cents and 6 ringgit 53 cents respectively. Conversely, Hong Leong Bank, they experienced a brief pullback, slumping 50 cents to 25 ringgit 30 cents following a period of profit taking. Other notable blue chip performers included consumer giant Nestle. They rose by 1 ringgit 40 cents to 113 ringgit 40 cents, and healthcare leader IHH Healthcare, they advanced by 14 cents to 9 ringgit 10 cents. Now, in the broader market, trading activity was more varied. Hop Seng saw a marginal dip, while Zentech remained flat. Now, Gamuda Berhad, a key proxy for infrastructure and data center growth, they edged down 9 cents to 4 ringgit 33 cents during the early trade. Now, we're going to be moving on to some local currency and foreign exchange. The Malaysian ringgit, we opened on a softer note against the US dollar this morning, retreating from its recent multi-year highs as unexpectedly strong manufacturing data from the US revitalized the greenback. Now, despite this dip against the dollar, the local currency showed resilience by gaining ground against other major global currencies following the long weekend. So at 8 a.m. this morning, the ringgit slipped to 3.9540 or 3.9650 against the US dollar. And that's compared to its last close of 3.9440 or 3.9500 that was on Friday before the long weekend. Markets in Malaysia were closed, of course, on Monday for the Thai Pusam and Federal Territory public holidays. Now, the shift in momentum was triggered by the Institute for Supply Management, ISM, which reported that the US Manufacturing Purchasing Managers Index, the PMI, it surged to 52.6 in January, up from 47.9 in December 2025. Now, this reading signifies the first expansion in the US factory sector after 26 consecutive months of contraction, far exceeding that of market expectations. Bank Muamalat Malaysia Berhad Chief Economist Dr. Muhammad Afzal Nizam Abdul Rashid, he noted that the US dollar index headed north immediately following the release. Afzal Nizam said that the data suggests American companies have become increasingly optimistic, although the survey also indicated a certain degree of pessimism regarding inventory levels. On that note, the ringgit could experience a weaker trajectory today. Take note on that. Now, while struggling against the dollar, the ringgit did outperform a basket of major currencies. Our ringgit appreciated against the euro to 4.6649 or 4.6779. It also climbed against the Japanese yen to 2.5426 or 2.5498. We also saw the ringgit gain against the British pound, trading at 5.4059 or 5.4209. However, the local note faced downward pressure against its ASEAN peers. It weakened against the Singapore dollar to 3.1092 or 3.1184, as well as the Thai baht to 12.5488 or 12.5941. Our ringgit did edge lower against the Philippine peso and the Indonesian rupiah as well, reflecting a broader regional recalibration as traders reacted to the robust US economic signals. Now for some local economic news. Malaysia's manufacturing sector has entered the new year on its strongest footing in nearly 2 years, with the headline S&P Global Manufacturing Purchasing Managers Index, or the PMI, rising to a 20-month high of 50.2 in January. Now, this marks the third consecutive month of improvement, signaling a sustained recovery in business conditions across the country. The uptick from 50.1 in December was primarily driven by a renewed increase in production, the strongest growth recorded since July 2022. Now, according to S&P Global, factory output returned to expansion territory as new orders stabilized, and that's supported by fresh strengthening in demand from overseas markets. In a significant shift, manufacturers reported the first reduction in input costs since May 2020. This deflationary trend was largely attributed to the appreciation of the ringgit, which made imported raw materials much cheaper. Now, with lower input costs, output prices increased only marginally, helping Malaysian goods remain competitive globally despite rising price pressures elsewhere in the ASEAN region. Now, S&P Global Market Intelligence economist Mariam Baluch, she said that the Malaysian manufacturing sector signaled strengthening business conditions for the third straight month in January. Production returned to growth while demand conditions stabilized. She further noted that another key element from the latest survey was the first fall in input costs since May 2020, as firms benefited from the effects of a stronger ringgit, and a lack of inflationary pressures should hopefully help to support growth in the months ahead. Now, while Malaysia's PMI remains just above the neutral 50.0 threshold, its cost reduction story stands in contrast to the broader regional trend. While the regional average indicates faster growth, it has also been accompanied by a 14-month high in input cost inflation, a pressure Malaysia has largely avoided due to its currency strength. S&P Global noted that historical correlations between PMI movements and official data suggest the economy entered the new year with steady GDP growth alongside continued year-on-year expansion in official manufacturing production. Now, optimism regarding future output reached its second highest level since 2013 as firms cited expectations of new contract wins and improving global demand. It's good news for Malaysia's manufacturing sector indeed. And now, continuing with more economic news updates, HSBC Global Investment Research has maintained a bullish outlook for the Malaysian economy, projecting a gross domestic product or GDP growth of 4.5% for the year 2026. Now, this forecast places Malaysia at the top tier of the government's official target range of 4 to 4.5%, signaling a steady trajectory despite lingering geopolitical uncertainties. Now, the research house noted that Malaysia's economic performance has been remarkably consistent, posting approximately 5% growth over the last 2 years. Now, this resilience has been mirrored in the currency markets, where our ringgit recently surged to an 8-year high of 3.92 against the US dollar. That was on January 28th. Now, HSBC's ASEAN economist, Yun Liu, she said that these positive developments are timely reminders of Malaysia's economic strengths: strong growth, resilient trade, investment appeal, fiscal commitments, and steady monetary policy. A primary driver of this optimism is the country's robust trade sector. Now, despite a 19% headline tariff imposed by the US, Malaysia's trade volumes reached record highs in 2025. Now, this success is largely attributed to the nation's specialized focus on electrical machinery and electronics, which continues to benefit from the global surge in AI-driven semiconductor demand. Now, Liu also highlighted that Malaysia has successfully secured a significant market share in critical components like processor chips and integrated circuits. She added that, fortunately, Malaysia is exporting the right products that are currently in heavy demand, though she did caution that potential US tariffs on semiconductors remain a sword of Damocles for all tech-exposed nations. Beyond manufacturing, tourism has also surfaced as a dominant secondary growth engine. In 2025, Malaysia officially overtook Thailand as the top destination in ASEAN. Now, this shift was fueled by the visa waiver program for Chinese tourists, which pushed tourism receipts above 10% of the national GDP. Looking ahead, the Visit Malaysia 2026 campaign is expected to further this momentum, targeting 47 million visitors and aiming to lift tourism revenue to 16% of GDP. On the policy front, Malaysia continues to demonstrate fiscal discipline. The government successfully narrowed the fiscal deficit from 6% during the pandemic to 3.8% in 2025, with a further reduction to 3.5% targeted for this year. Meanwhile, Bank Negara Malaysia is expected to maintain the OPR, or overnight policy rate, at 2.75% throughout the year, providing a stable anchor for the economy while regional peers move toward easing. We'll now take a short break, but don't go away, investors. We will return shortly with corporate news developments right after this. And welcome back to the Midday Roundup. Let's continue with some corporate news updates. So, Public Mutual, the wholly owned unit trust subsidiary of Public Bank Berhad, has announced gross distributions exceeding 64 million ringgit for 4 of its funds for the financial year ended January 31st, 2026. Now, the payouts included significant distributions for both conventional and Sharia-compliant bond and equity products. Leading the list are the Public Enhanced Bond Fund and the Public E-Sukuk Fund, both of which declared a gross distribution of 4.75 cents per unit. Now, in a quote, they said, Public Mutual is Malaysia's largest private unit trust company with more than 180 funds under its management. As an established player in the industry, the firm also serves as an approved private retirement scheme PRS provider, currently overseeing 9 PRS funds across its extensive network of 31 branches and customer service centers nationwide. Now, according to the official declaration, the total gross distributions are as follows. The Public Enhanced Bond Fund is 4.75 cents per unit. The Public E-Sukuk Fund is 4.75 cents per unit as well. The PB Dividend Builder Equity Fund is 0.40 cents per unit, while the Public Islamic Optional or Optimal Growth Fund is 0.05 cents per unit. All 4 funds follow an annual distribution policy where income is paid out to investors on a best effort basis. Now, the firm highlighted that existing account holders could facilitate their investments through various channels, including the PMO Plus mobile app or by visiting any Public Bank branch. Well done to Public Bank. Up next, we have some business updates. Analysts are maintaining a cautious stance on Malaysia's oil and gas services sector following the release of the Petronas Activity Outlook, or the PAO, for the years 2026 to 2028. While global Brent crude prices recently surged above $70 per barrel due to heightened geopolitical tensions in the Middle East and supply uncertainties in Venezuela, market experts warned that the rally is driven by a repricing of risk rather than a structural shift in supply and demand. Now, the latest PAO report suggests that domestic upstream activity will remain uneven, while segments like hookup and commissioning, or HUC, and also plant maintenance are expected to stay resilient. Others, specifically drilling rig demand and offshore support vessel utilization, are projected to moderate in the year 2026. Now, this trend reflects a normalization of activity levels and the ongoing regulatory impasse between Petronas and Sarawak's Petros. Stefan Inez, the managing director of SPI Asset Management, noted that the surplus narrative is still there, just temporarily muted by geopolitics and positioning. Near-term balances can tighten even in an oversupplied world. Then outages, weather, and geopolitics collide. That's how prices can rally, while the medium-term math still points to too many barrels. He also noted that the current oil price strength is effectively a geopolitical insurance premium, triggered by the US-Iran tensions and potential flow risks in the Strait of Hormuz. Now, the PAO guidance indicates that while exploration activity is set to ramp up significantly in 2026, the benefits for service providers may be felt only later. Kenanga Research cautioned that the benefits for upstream service providers are likely to be felt later, as exploration spending typically translates into development and production work only in subsequent years. Now, for 2026, the research house, Kenanga, highlighted that guideposts for maintenance, drilling, and OSV requirements have declined compared to previous outlooks, signaling a more cautious activity environment. In contrast, Hong Leong Investment Bank Research have identified HUC and plant maintenance providers as the primary beneficiaries of the current cycle. Now, Hong Leong Bank Research House, they stated The resilience in HUC demand is expected to provide earnings support for contractors with stronger exposure to commissioning works. Now, this is expected to favor companies such as the Berhad, while a gradual downtrend in offshore maintenance, construction and modification activity levels may pose a mild headwind to players like Dayang Enterprises Holdings Berhad. Despite the softer forward guidance from Petronas, analysts believe much of the negativity has already been priced into the valuations of listed upstream service providers. With balance sheets in better shape than in previous cycles, the risk of further asset impairments remains very low. However, the sector continues to wait for more definitive catalysts, particularly as the legal dispute over Sarawak's oil and gas rights moves toward a crucial federal court hearing on March 16th this year. And finally, we're going to be wrapping up with some global market developments. Global equity markets retreated on Monday as a massive liquidation in precious metals dominated investor sentiment, even as Wall Street indices managed to post gains ahead of a high-stakes week for corporate earnings and central bank policy. Now, the MSCI Global Equities gauge edged down by 0.05% to 1,043.77. That's caught between a resilient US stock market and a sharp correction in the safe haven assets. Now, the most dramatic action occurred in the commodities complex, where silver plummeted 5.56% to $79.92 an ounce. Now, this followed a staggering 27% rout on Friday, marking the metal's worst two-day performance in decades. Now, gold also felt the weight of the roller coaster descent, falling by 3.85% to 4,676.28. Analysts pointed to a gravity-driven correction following last week's record highs, and that was exacerbated by margin hikes from the CME Group and a deepening sell-off in Chinese future funds. Carol Schleif, the chief market strategist at BMO Private Wealth, noted that the key thing that seemed to turn sentiment today is a pushback on focusing on fundamentals. Now, she highlighted that positive headlines regarding artificial intelligence funding helped U.S. markets snap a three-day losing streak. The Dow Jones Industrial Average also rose by 1.05%, while the S&P 500 and Nasdaq gained 0.54% and 0.56% respectively. That's as investors braced for upcoming earnings from the tech titans Alphabet and Amazon this week. In the currency and bond markets, the dollar strengthened as traders assessed the nomination of Kevin Warsh as the next Federal Reserve Chair. While Warsh carries a historical reputation as an inflation hawk, recent commentary suggests he may favor productivity-linked rate cuts, leaving the market in a state of slow-motion flight to safety. Now, the US dollar index rose 0.37% to 97.59, while the 10-year Treasury yield climbed to 4.281% as investors recalibrated their interest rate expectations. Energy markets also saw significant volatility, with US crude settling down 4.71% at $62.14 per barrel. And this decline was fueled by optimism for a diplomatic breakthrough between US and Iran, following reports that both nations would resume nuclear talks on Friday in Turkey. Now, there is a slow-motion flight to safety underway across the currency markets, and that's driven by last week's implosion in the precious metals complex. That was said by Carl Shimoda, the chief market strategist at Corpay. As major central banks in Europe, the UK, and Australia prepare to meet later this week, the global financial landscape remains characterized by a shift away from overstretched commodity valuations and toward the relative stability of earnings-driven equity growth. That's a wrap for the Midday Roundup with me, Wanizel, on KleverStock. Hope you guys are having a wonderful break. Thank you so much for choosing us investors, and stay tuned for more upcoming live stream programs later on throughout the day. We'll see you soon.